long. Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We got to take a look at what I was left when I became president and what Mr. Trump left me. The economy collapsed. There were no jobs.
The tax cut spurred the greatest economy that we've ever seen just prior to COVID and even after COVID.
The fact is that the vast majority of constitutional scholars supported Roe when it was decided. The idea that states are able to do this is a little like saying we're going to turn civil rights back to the states.
As far as Russia and Ukraine, if we had a real president, the president that knew, that was respected by Putin, he would have never invaded Ukraine.
The only person on this stage is a convicted felon is the man I'm looking at right now.
He did beat Medicare. He beat it to death, and he's destroying Medicare because all of these people are coming in. They're putting them on Medicare. They're putting them on Social Security. They're going to destroy Social Security.
During the night, there were an awful lot of emails and texts from Democrats who are now really worried about losing the House, the Senate, and the White House.
This report itself was probably the best that one can expect, and it certainly helps the Fed, I think, give them a little bit more comfort on their path to starting to ease policy, which we still expect to start happening in September.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. We've got a little bit of a deterioration in the major averages over the course of the day, even with that PCE, a measure of inflation, coming in line with estimates. And as market participants try to suss out what last night's debate means, if anything, we've got the Dow lower right now by 157 points. That's about 1/3 of 1%. The S&P off 1/4 of 1%, and the Nasdaq off about the same. You can see all of them showing that downward turn as the day has gone on. A couple of things to note here. One, of course, it's the last day of the quarter. And so you do have some market participants kind of doing some end of quarter settling up of accounts. In some cases that might be selling, in some cases it might be buying, but that also plays into what we tend to see on the last day of the quarter. It's also, of course, the last day of the first half of the year, and it's been a pretty remarkable gain that we've seen for the major averages. We've got the Nasdaq up 19% this year. By the way, the Nasdaq and the S&P earlier today were set to close at records before this little bit of a pullback. The S&P up almost 15% for the first half of the year. The Dow, the laggard, pretty notably here, up 3.5%. And then there's something else that we have been watching very closely that's been a big theme for the first half of the year pretty consistently throughout, and that is breadth in the market. How many stocks are participating in the big gains that we have seen? And as we know, it's not that many, right? A lot of the gains, the bulk of the gains are accounted for by mega cap tech stocks. So we've got the S&P equal weight index much more in line with what we saw from the Dow than what we saw from the S&P 500 itself, implying, again, that lack of participation. Another way to look at this cool chart brought to us from Dow Jones, which shows the gap in performance between the S&P 500 and the S&P equal weight, another measure of breadth. And you can see here that really what we have seen is a huge outperformance, and again, another way of measuring this lack of breadth in the market, this chart goes all the way back to 1990, and this is the largest gap, at least since then. This has led a lot of strategists to question the sustainability of the rally if all those other stocks don't start participating in a more significant fashion, Josh.
All right, Julie. In Thursday night's debate, a soft-spoken and halting Biden did little to assuage fears that the 81-year-old is capable of serving for 4 more years.
Making sure that we're able to make every single solitary person eligible for what I've been able to do with the with the COVID. With dealing with everything we have to do with. Look. If we finally beat Medicare.
Thank you, President Biden.
With us now, Libby Cantrill, PIMCO head of U.S. Public Policy. Libby, you're the perfect person to talk to about this. I'm so happy to have you on the show today. Maybe just start big picture, Libby. You watched that debate. What did you make of it, Libby? What were your big takeaways?
Yeah, well, I mean, I think that clip encapsulated a lot of it. I mean, that was a very low moment for the president. Unfortunately for his campaign, there were many of those moments. Even in the best moments, he was having a hard time making a point, landing an insult. Clearly, he had rehearsed a lot of the comments that he did make last night, but they just did not gain traction. And to your point, none of what we saw last night reassured voters that not only is Joe Biden, can he make it through 90 minutes, but he can't make it necessarily through 4 years. But I think that the most important thing here for markets is that Joe Biden doesn't seem to be indicating that he is going anywhere. And I think that folks, and I say it's sort of the West Wing effect, they do sort of think that somehow the party, the Democratic Party, this is sort of this big conspiracy, and that there will be somebody else put on the ticket. That may be the case, but it seems unlikely. This is Joe Biden's decision to make. And mechanically speaking, he is the person, the candidate who controls all of the delegates, 99% of the Democratic delegates, Joe Biden controls. So only Joe Biden can release those delegates and allow them to support another candidate. So I think mechanically here, very difficult, not impossible, but difficult to see at this point Joe Biden dropping out of the race. The last thing I will just say is that the tell has been in Minority Leader Hakeem Jeffries, in former Secretary of State Hillary Rodham Clinton, in former President Obama. They have all tweeted over the last few hours that, yes, he did not have a good debate, but that does not make him a bad president, and that folks should be focusing on his values, not necessarily on what he said last night. So we'll see if that actually gains any traction with the voters. But for now, it looks like President Biden is absolutely in this race.
Yeah, I mean, it was pretty remarkable this morning to see almost pretty much unanimous reaction on the op-ed pages of the New York Times, in contrast with those surrogates you were just talking about, all of whom pretty much called for Biden to step aside. And Libby, maybe this is a West Wingy kind of question, but if indeed Biden does not make the decision to step aside and relinquish those delegates, is there any path for someone else to become the candidate?
You know, there was a path in the 1960s before the parties changed the primary rules, but now the primary voters have voted, and they have voted for Joe Biden. And as a result, Joe Biden has gotten the vast majority of the delegates at stake. He will technically be the nominee. So unless the DNC changes the rules, which you just cannot see happening, again, Joe Biden will be the nominee, again, unless he makes the decision. Now, donors could put pressure on him. Pundits could put pressure on him. I do think, again, a tell is that the fact that President Obama has come out in support of Joe Biden is very important, because he is probably another person who could have put pressure on him to drop out. But that does not look like it's going to be the case. So a long way of answering your question, no. At this point, there really is no other mechanism to push Joe Biden, mechanically to push Joe Biden out.
What do you think, Libby, Biden actually does now, though? I mean, post-debate, what do you think, what shifts or changes in strategy or messaging would you be looking for?
Yeah, so I think a couple of things. I mean, one is he's actually just had a rally in North Carolina, and of course it was based on a teleprompter, but the Joe Biden of the State of the Union back in March, which was much more on display today, certainly than he was yesterday. So I think that the campaign will just try to push him out as much as possible. I don't think we will see another debate. We will see. There's supposed to be another debate scheduled on September 10th, of course. I'm not sure whether President Trump really thinks that there's a lot of benefit for him to actually go into that debate, given how well he did yesterday. So, that is something else to be watching. The other thing I will just say is, in terms of polling in the next few weeks, we know that folks, the swing voters, really don't like, they're called double haters for a reason. They really don't like Joe Biden, but they don't also like President Trump. And so where does that potential support go? And I think if we see an uptick in the third party figures, that actually could be pretty interesting because a third-party candidate is not likely to be the next president of the United States, but could very well be a spoiler in this very close margin race. And then the other thing I would just say is that the choice of running mate for President Trump, important just because, again, both of these gentlemen are of advanced age, but I actually think the vice president's debate will be really important. That hasn't been necessarily scheduled yet. We're thinking of a sort of end of July, early August timeframe, but that also could be important. Just I think the stakes, the focus on the running mates now, I think is probably going to be, a bit clearer and a little bit starker after last night.
And presumably will be a younger person, whoever Trump ends up picking. So it'll be a very different debate, Libby.
Hard for him to be older at this point, yes.
So almost all of the debate reaction has centered on President Biden's performance. Much less has been around former President Trump's performance. But, and much has been made of how he sort of was more conventional in the first half. But then he got wackier and wackier as the night went on. Manchurian candidate kind of stuff. Is that kind of irrelevant at this point? Are voters just sort of used to that?
I do think that they are used to it. They are used to, a lot of folks just rationalize that as, Donald Trump being Donald Trump. He was, I think the Biden campaign really did want to make this a contrast in temperament and personality. And they did, but not the way that they wanted to. I mean, Trump was much more disciplined. He was much more restrained. You're right at the end that maybe he let a little bit of that restraint go. But for all intents and purposes, this was a different candidate than we saw, certainly that first debate back in 2020, where President Trump, we now later know had COVID and what have you. But I think the point here, again, for markets, is that if Joe Biden does stay in, and again, I think that is our base case, there is a higher chance that we see President Trump become the president. And not because necessarily he gets many more votes after last night, but the folks who may have voted for Biden maybe just don't turn out, right? I think in some ways, turnout may be lower. We'll see. Again, 4.5 months to the election, a lot can still change. But I think, at least as of now, the upshot here is that there is a higher chance today than there was yesterday of a Trump presidency. And so when does the market start pricing in particular, tariff risk? I mean, I think this is something that we have reiterated to our clients over and over again. We need to take President Trump both seriously and also somewhat literally in terms of his threats, in terms of increasing tariffs. Tariffs, just a fancy word for taxes, as we all know, also potentially inflationary and potentially a headwind for growth. So I think it's a question of, when do the markets actually kind of get around to the fact that, yes, actually Trump does have a very decent, higher than 50% odds at this point of getting elected. And, when do they actually start sort of manifesting that in terms of markets?
Libby, I'm going to get you out of here on this. You mentioned that VP debate. I'm looking forward to that too, Libby. I want to know, who do you got? You want to play some bets here on Trump's VP? Tim Scott, Vance, Huckabee, Sanders. Come on, Libby, give me some odds.
I mean, I'll tell you what the conventional wisdom says in Washington. By the way, the conventional wisdom is almost always wrong. But the conventional wisdom is that it is Senator Marco Rubio from Florida, Governor Doug Burgum from North Dakota, or J.D. Vance from Ohio. The one thing I think that Marco Rubio has in his favor is that, of course, he is of Hispanic descent. He's of Cuban descent. He can speak Spanish on the campaign trail in the Nevadas and Arizona's crucial swing states for Trump to win. But also that then allows for Governor DeSantis to appoint another senator from Florida, and I think Byron Donalds could be a candidate. So in some ways, this could be sort of a twofer, if you will, from Trump's perspective. He gets Marco Rubio, somebody of Hispanic descent, but then also he could have, another black senator ascend to that seat, and that's something that he could also campaign on. So I would say, if I had to commit now, I think Marco Rubio probably would be in the running. But again, that's the conventional wisdom, and the conventional wisdom is probably, like it always is, like usually is probably wrong.
Libby, there are fewer people we would rather talk to today on all of this stuff than you, and we really appreciate your time.
Thanks so much. Appreciate it.
Thanks. Well, President Trump appeared back on the campaign trail today, President Biden appeared on the campaign trail today, attempting to dismiss concerns around last night's performance.
I don't walk as easy as I used to. I don't speak as smoothly as I used to. I don't debate as well as I used to. But I know what I do know. I know how to tell the truth.
Joining us now, Yahoo Finance's Rick Newman. Where was that guy last
That's exactly
night?
what I'm
Who
wondering.
Was that?
So what medication did he take that instantly fixed his voice, 12 hours later? I don't know. I have no idea what to say about this. I mean, that is not the guy we saw last night. Most of the people who saw the debate last night are not going to see Biden in that clip. And we basically have 2 or 3 Joe Bidens running for president, I guess.
I mean, the other thing is the viewership of the debate last night was down
low,
considerably. But that's not how people watch things
right.
anymore.
Right, exactly
They
right.
watch viral moments. And we all watched earlier the clip that went viral, which was the president's comments about...
He just blanked out.
Right,
I mean,
yeah.
he just lost his train of thought completely.
Which happens to all of us. But
Well, all of us don't run for president.
Exactly. Well, and that wasn't his only moment like that during the night. That was the one that has just been sort of spread most virally.
Right. So, what could change the outlook here? I mean, is Biden sunk? I mean, you heard Libby Cantrell saying, and I think that's astute, that Biden is in this race. He will be the last person who thinks he needs to drop out, and he certainly doesn't feel that way now. So we were, before this debate, we were having a lot of discussion like watch for surprises in this election, right? Well, we got kind of a surprise, which some people say it's not surprising, but Biden totally crashed and underperformed last night, obviously. Could we have any more surprises? The answer is yes. So Donald Trump gets sentenced on January 11th for 34 felony.
July 11th.
Sorry, what did I say? January? Sorry. July 11th, 34 felony convictions. There's a good chance he will get some punishment. He's probably not going to get, go ahead, you're fine, time served. He could get home detention, which creates the surreal scenario that he may be accepting the Republican nomination remotely on a Zoom call because he's not allowed to leave his home in Florida. We're going to get this Supreme Court decision next week on whether Trump is immune in one of those 3 other trials he's facing. Small possibility that that could clear the way for that trial to begin, probably not end, but small chance that trial could start. And I mean, again, these guys are both old. There are still other surprises that could happen. So it's until the election day itself, it is always possible that the definitive thing that will decide the outcome here has not yet happened.
What do you think, Rick? I mean, there's a lot of talk right now. Is actually Biden going to be the candidate? I know we just spoke to Libby Cantrell, and she's right. You've heard from Barack Obama and Hillary Clinton, but I mean, I'm still waiting to get line of sight of the big donors, the big names who write the checks. I think that's going to be really interesting as that kind of leaks out. I'm still waiting to see do Democratic congressmen go public with worries. I mean, if you were to place the odds, how likely is it? Do you think seriously that Biden is not the candidate and that it is going to be Kamala Harris or Gavin Newsom?
Libby, in her note today, said it probably went up from about 10% to 20%. I think you could push it a little higher.
Even higher than 20%?
You could. Yeah, you could say 1/3, I guess. But if it doesn't happen soon, it is not going to happen voluntarily. If there's a health emergency, that's a different story. But Biden controls his delegates, as Libby pointed out. They're not up for grabs. He won those delegates in primary elections, and they're his delegates to dispense with as he chooses. So who can persuade Biden to withdraw, and who might do it? His wife. He's close with his sister. He's got a few family members, and I think that's about it. He's got 5 super close friends and political advisors he's had for decades. If all of them got together and collectively said, we're performing an intervention here, then maybe that would get it done.
You're suggesting Joe Biden has that much influence, you think?
Yeah. Oh, yeah.
And the other thing is, if he did step down and somebody else would run, one of the people you mentioned, the Democratic Party would want a sure thing, and there's nobody else out there.
That's another problem.
I mean, it's not that Biden is a sure thing either.
Yeah, so, Lyndon Johnson withdrew earlier in the year in 1968, and Hubert Humphrey was the vice president, so Hubert Humphrey stepped in right in as candidate. You assume that Kamala Harris would play that role, except I think there would be instant opposition to her. You'd have immediate jockeying from other people, super ambitious people. We've been going through the list all day, but Gavin Newsom, California governor, Pete Buttigieg, you know, in the cabinet, Gina Raimondo already in the cabinet. These guys are already inside the Beltway. They would be vying, you know, they would suddenly be going after Biden's delegates. And how does that shake out? I mean, there's a method, there's a procedure to make it happen. It would just be ugly, and then you probably have all this infighting in the meanwhile, right, which might be even worse than a Joe Biden. You know, the Democrats had a civil war 3 or 4 months before the election is a worse look than Biden put on last night. So this late in the game, there are not very many reasonable options for Democrats.
Thanks, Rick.
By the way, the comeback theme is already showing up among the hopium Democrats.
Yeah,
you know,
well,
Biden is apparently Biden started his comeback today at that North Carolina rally.
Well, we'll talk to you next week about the next development.
When the comeback is really picking up steam.
When the comeback. Okay. We're just getting started here in market domination. Coming up, Nike having its worst day in over 20 years as analysts turn bearish on the apparel giant following its latest earnings report. We'll check in on some of our top calls of the day later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. Stay tuned. Much more market domination still to come.
Declines on Wall Street accelerating here into the close. The Dow near the lows of the day. The moves coming after the latest PCE reading showed more signs of cooling inflation. And joining us now is Shana Sissel, Banrian Capital Management CEO. Shana, it's good to see you. So let's start there with that PCE print. You know, Shana, it came in as expected. What did you make of it? What do you think Jay Powell made of it?
Well, I think it's going to be good news for the Fed. I think Chairman Powell will be happy with what he's seen. We had slightly higher personal income numbers, but PCE came in right in line and continues to show slowing. So having a strong consumer and slowing inflation, that's kind of exactly what they're looking to achieve.
And Shana, everybody's out with their sort of mid-year outlooks lately, and there seems to be a lot of continued bullishness out there. Although you've got the likes of Marko Kolanovic over at JP Morgan who are saying that the earnings broadening is just not going to have trouble materializing enough to continue to boost stocks from here. Where do you sit?
Well, I think that for the larger cap and the mega cap names, we will continue to see broadening earnings. My concern is more on the smaller cap names, which have struggled all along and continue to underperform. I don't see much of a tailwind or any sort of catalyst for that to turn around anytime soon. But I do think that having slowing inflation could very likely lead the Fed to do a rate cut in September, which could be a catalyst for continued economic growth and continued positive market returns going into the end of the year.
What about, Shana, that jobs report we're getting next Friday? How important do you think that is in terms of just confirmation the Fed needs of when they do start cutting? Could that shift, you think, that September cut you're possibly expecting?
I think the only way it would impact the probability of a September cut is if it came in too strong. Because remember, there's a dual mandate here. So they're concerned about inflation, but they're also concerned about employment. And if the labor markets look hot, that is a negative and unlikely to result in a rate cut. That has not been what we've been seeing in recent months. In fact, they've been making adjustments to previous months down, and the unemployment rate has been ticking up ever so slightly. So unless something very surprising happens, I expect that to continue to this trend of a healthier, less tight job market, which again would be positive for the Fed.
So Shana, put it all together for us and tell us about strategically how you're thinking right now and you know, where you're sort of adding to positions.
So we've seen on a technical level increasing correlations between equities and fixed income, and Banrian is focused on alternative investments in general. So we see a lot of opportunities here to add diversification of portfolios through things like managed futures, commodities, real estate debt, things of that nature, just to sort of take advantage of their diversification benefits as we see this rise in correlation between fixed income and equity, which has been a problem now for quite some time. I want to say for the last 2 years. We think that that's where the real opportunity is to maintain strong portfolios and continue to have potentially even good income with things like real estate debt. I think the opportunity is now to really add these types of things into portfolios.
What about, Shana, the AI trend? You know, we did hear from Micron this week. They reported investors were disappointed with that print. How are you thinking about that mega trend, and how do you want to invest in it?
So there's no mistake. I am a NVIDIA bull. It's one of my favorite stocks and has been for years now. I talk about it a lot, so your viewers who have seen me before will know that. I am a bull on AI. I think we're very early in the development of AI technology. I think it impacts every single industry, and the biggest player and the leader in the space is. Now, there's other opportunities. I like to say NVIDIA has done so well that let's look at some second derivative opportunities, things that are the next potential beneficiaries of the development of AI, and look at something like Verdit VRT, which does cooling systems for data centers, which is very important because there's a lot of computing power needed for these machine learning technologies. That's one. And then there's some firm like Cisco, which is a stock that I've been burned on a ton, but it's very cheap and it does have a second derivative exposure to AI that could benefit that stock going forward. So those are some of the names I like, and that's kind of how I'm looking at it is we know NVIDIA is going to win, but who wins next?
Yeah, it's a good way to look at it. Shana, thank you. Appreciate it.
Thank you.
Let's check in on some trending tickers now. And we're starting off with Uber and Lyft. Shares of the ride-sharing companies rising after both agreed to offer a minimum wage, paid sick leave, and other benefits for drivers. This is all part of a $175 million settlement with the state of Massachusetts specifically. So this means the drivers in Massachusetts are going to be getting $32.50 an hour. That's the minimum wage. Of that settlement, Uber's going to pay $148 million of it. Lyft will pay the remainder. But, you know, you've got all these sort of regulatory overhangs in different regions, and so this removes one of those.
Yeah, I was reading that most of the funds, it sounds like you're going to be, it's like they'll be distributed as back pay to drivers, former and current. Kind of this broader fight. I mean, often the companies want to, it sounds like, kind of hammer out these deals that give driver benefits, but still, you know, kind of classify them as independent contractors.
Yeah, and in addition to this, Uber and Lyft are going to withdraw their support. There was a referendum in Massachusetts as well that was asking voters there to say, yes, indeed, these folks are independent contractors. Now Uber and Lyft aren't going to support that referendum. It doesn't mean it's not going to pass, but they're not going to push it as they have been as part of this settlement.
And I was reading that there's actually more news on this front. I was reading that we're still waiting for a decision from the California Supreme Court about this 2020 voter-approved ballot measure that classifies drivers as contractors. So you got more news on the way there.
There's a lot going on there. Let's talk about a deal today as well. Network provider Infinera's stock soaring today after agreeing to be acquired by Nokia for $2.3 billion. So basically, this is Nokia's attempt to get in on AI further and will, according to some analysts, be competing more with the likes of Cisco and Ciena, which are networking equipment companies as well. This is the biggest deal that we have seen from Nokia since it bought Alcatel-Lucent back in 2016. That was a much bigger deal. But nonetheless, we haven't seen a deal like this in a while.
No. I mean, and Nokia's CEO here saying to call reporters, you guessed it, it's about AI, Julie.
Yes.
AI is driving significant investments in data centers at the moment, and one of the key attractions of this acquisition, they're saying, is that it significantly increases our exposure to data centers. I did think it was interesting, those Bloomberg analysts pointing out just how it does potentially maybe make some shifts in the competitive landscape here, calling out, you know, Cisco and Ciena there.
Yeah, definitely. We'll see how it plays out.
All right, coming up, it's the latest edition of our series, Goodbye or Goodbye. Stay tuned. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're scoping out the relationship between retail and artificial intelligence. I'm here with Granite Shares founder and CEO, Will Ryan. Good to see you, Will. Thanks for being here.
Thanks, Julie. Good to see you too.
So let's get to your buy stock, and that is Amazon. And the stock has already done quite well over the past year. It's up around 50% here. So let's talk about your continued case for why it could go up. And it starts with that market cap milestone. And I guess you could argue the wind is sort of at its back.
That's right. There's a lot of momentum. Clearly, the company has made a number of changes since the pandemic, all which has benefited them really greatly. And I think the $2 trillion is just a nice, milestone to say that Amazon is back, but it's in the league now with the Nvidias and the Microsofts and the other $2 trillion market cap companies.
Yeah, and speaking of those other companies, of course, one of the reasons that we have seen them gain so much is what's going on with AI. So where does Amazon sort of fit into that universe right now?
So Amazon is lucky because it benefits from its Amazon Web Services business, and it's one of these hyperscaler cloud data center businesses, which is benefiting from the huge demand that we see everywhere in the market for AI and for AI-based products. So that was one area of weakness that Amazon had in the last sort of couple of years, where the growth in that AWS business slowed down, but we're starting to see a re-acceleration of AWS and the services that Amazon's providing, again, all on the back of demand for AI.
Yeah, and of course, they're also using AI, not just for AWS, but in the retail business. I mean, they've always used machine learning and AI, but I imagine now, they know everything about me, unfortunately, as a Prime customer, and I'm sure they're using it to their advantage.
Yeah, absolutely, and this is only going to get better. So the convenience, all the things that Amazon does to offer the best kind of product and service to the consumer is only going to be augmented by further advances in AI.
Yes, upselling me more stuff. And then finally, it's not just on the demand side, right? It's also, they're still sort of cutting costs and getting leaner.
That's right. And again, one of the big things that Amazon did was, in an environment perhaps where we had zero interest rates and we had a market that was awash with liquidity, the market share pursuit type strategy that Amazon was pursuing was maybe the right idea or the right strategy for that time. But clearly, with the interest rate environment that repriced all business models like that, there had to be a focus on costs. There had to be a focus on efficiency, on improving margins. And that was the discipline that was injected into Amazon. And so the new CEO, of course, has really focused on that, the last few years. And the business, from a margin perspective, profitability, efficiency has improved vastly.
And you expect them to continue with the cost cutting, or more just sort of reaping the benefits of it?
No, absolutely. The company's laid off, I think, 27,000 people over the last few years. There have been big, efforts to improve on the logistics side of the business, to manage inventories better. And I think the market clearly loves that part of, the Amazon story, hence part of the $2 trillion market cap.
Right.
So from that perspective, I think there's no reason to believe that the company won't continue to do this.
All right, let's talk about what could potentially be a risk here, and that's that there could be a slowdown for AWS. Is that because of market share issues, or how could that happen?
I think it's more what we saw before, such as if AI doesn't turn out to be the growth story that perhaps everyone predicts, or just a lack of spending from a competitive perspective vis-a-vis other competitors. Amazon's not the only player in that space. It competes with other hyperscalers in the business, such as Microsoft's Azure product or Google's cloud solution. So it could suffer from competitive pressures on that front.
Mm-hmm. All right, let's get to the stock that you think folks should avoid on the retail front, and that is Walgreens Boots Alliance. The stock is already down some 50% or so over the past year, so kind of a mirror image of what we've seen with Amazon. And it just reported third quarter numbers that the street did not like, cut its outlook, so it has been struggling.
That's right, and Q3 numbers were horrible, and I think, again, it's a useful case to position it against a stock like Amazon to really think about the challenges that a lot of these quote-unquote traditional retailers are facing. And this is a combination of all sorts of factors, but unfortunately for the Walgreens franchise at the moment, very challenging time.
Yeah, and they're also shutting a bunch of locations. So we've got sort of broad consumer weakness. How is that playing out with Walgreens? Because on the one hand, the company sells stuff that people need in terms of drugs and stuff, but I guess there's also a discretionary factor.
That's right. It's a kind of tale of two halves in a way. On the one hand, you've got a lot of physical locations, and clearly Walgreens doesn't have the sort of technological online delivery and logistics part of the business that a company like Amazon enjoys. But the physical stores, too many physical stores, companies looking to rationalize by cutting down underperforming stores. And then within the stores themselves, the pharmacy business, the healthcare business is performing actually quite well, but the retail side much less so. And again, because it's competing with these larger players. The other challenge in pharmacy, of course, is the drug market and the fact that they can't fully control what they charge customers for prescription drugs. And that's also an issue that is broader than just Walgreens itself. So kind of a few pressures there.
Gotcha, macro pressures as well. And then finally, AI, is there any AI here when it comes to Walgreens?
Yeah, and again, there's no AI story because this is a story where it is a traditional retailer as such, and therefore doesn't have the luxury of a hyperscaling cloud data business to fall back on, or at least to be part of those services. And I think when you're talking about the convenience factors that companies like Amazon have improved that offering, consumers since the pandemic have gotten more and more used to convenience in everything that they do. It again makes it especially challenging for these more traditional retailers to compete in that environment.
All right, let's talk about what could go right for Walgreens, and that is sort of leaning into the business that you said is working, which is healthcare.
That's right, and we all know that the demographic issues that we have in this country around healthcare, and we all know that healthcare is a sort of a booming business at a very macro level, and will probably only get stronger as more and more, people get into retirement and have more demand for healthcare products and services. However, that part of the business, like I said, is actually performing quite well. It's really trying to rationalize the underperforming parts of the business. So I think if they can do that, and clearly that's part of the CEO's strategy, it's part of the strategy of the company to get rid of underperforming stores, to rationalize the product line, focus more on healthcare, then that clearly is the upside case for the business.
Right, well, we'll see if that happens. And meanwhile, you don't have a position in either of these stocks, right?
No, I do not.
Okay, well, thanks for being here.
Thanks,
Appreciate
Julie.
it. Good to see you. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern.
Let's get to a call of the day now. Nike gets 6 different downgrades today. That's including from Morgan Stanley. The analysts there highlighting another disappointing quarter and reducing the outlook for the shoe company. So, Nike those shares just nosediving today, Julie. The stock already was well in the red over the past 12 months heading into the print. But you can see it cratering there. Revenue in the fourth quarter fell 1.7% and missed. They offered a full year outlook that missed. And as we noted, the street's been responding. Morgan Stanley goes to equal weight, lowers the target to 79, saying the company's strategic changes leave us with low visibility into its P&L.
A decline of 19.5% or more in just today's session will be a record one-day decline for Nike here. What's going on? Well, Nike basically, over the past few years, according to analysts, and probably itself, has not been innovating enough, has not been refreshing its lineup enough, has not been necessarily performance forward enough with its footwear, and so it is trying to do that. It's going through sort of a transformation period. I talked to Anisha Sherman at Bernstein this morning, and she pointed to this sort of uncertainty around whether these new models are going to work and be appealing. The people aren't spending as much now, but they're willing to spend if they feel it's worth it, if they feel it's something fresh and interesting. And Nike has sort of fallen down on that job as of late. So I thought that was interesting. Jim Duffy over at Stifel was one of the other downgrades that we saw for the stock here. And basically he said, we can't support a compelling upside case until growth inflection becomes more tangible. It seems like there is some optimism that they can improve at some point. It's just that they don't seem to know when.
Yeah, when you see a print and look at it, down 20%.
Yeah.
You'd also wonder whether, how many folks on the street, but also investors, have questions about whether this is the C-suite, this is the management team that's actually going to turn this thing around and stick the landing.
Yeah, definitely. Well, the Supreme Court significantly weakening the power of the federal government, overturning a precedent from 1984. Joining us now with more, our own Alexis Keenan. Thanks so much for joining us, Alexis. And this was expected and also a big deal.
It was expected based on the conversation between the justices and the lawyers who presented oral arguments. However, it's a huge deal. It's a big overhaul in the way that agency laws are interpreted, because in the past, ever since 1984, there was a precedent at the Supreme Court, a conservative ruling ideologically, that the agencies, when they interpret laws that are ambiguous, when they're unclear, that judges, courts, they must defer to the agency's interpretation of that law. So that gave tremendous power to these agencies. So when they would pass a law, if there were some sweeping conditions within these laws, and you think of things like even COVID-19 and the FDA coming in and telling the public how things are going to go financially, health-wise, you have so many departments working together, it's the agencies. So the courts didn't really get involved too heavily because they knew that this law was on the books. Now everything changes, and what it was called is Chevron deference. The case comes from a case that involved the oil giant going all the way back now, 40 years? Did I say 20? 40 years. So this case, though, in particular, it involved the National Marine Fisheries Service, that's part of the Commerce Department, and you had commercial fisheries that were mandated under the Trump administration to put federal monitors on their boats, and they were trying to control overfishing of herring on the eastern seaboard. These fishing companies, they said, no, we don't like that because we don't want to pay for these monitors. But the federal government said, no, you have to pay. So that's how this particular case evolved. But this ruling came down 6-3 along ideological lines, with the conservative justices having the heavy hand there. And with Chief Justice John Roberts writing the majority opinion, he said Chevron was misguided because agencies have no special competence in resolving statutory ambiguities. He said courts do. So broad picture, the court has really pared down the federal agencies' power here. These are non-elected officials running these agencies, so you have to also take the point that, well, maybe we want elected officials or judges in this case making these decisions. But it's going to impact.
You could argue the agencies might not have statutory expertise, but they have expertise in the subject area that they're
have subject
ruling
matter
on.
expertise. Yeah.
Well, we'll see how this goes.
Could be a flood of litigation. We don't know yet.
Wow. All right. Thanks, Alexis. Appreciate it. Well, coming up at the halfway point for 2024, it's time for a mid-year checkup on Big Pharma. More on which names are best positioned for the months ahead is next.
In today's Yahoo Finance Playbook, we are doing a mid-year check on the pharmaceutical industry. A string of negative headlines and promising new developments present ideal buying opportunities for investors. And joining us now to discuss is Chris Shibutani, Goldman Sachs Senior Biotechnology Analyst in Global Investment Research. Chris, it's good to see you. It is that time of year, Chris, where it feels right to maybe take a deep breath and figure out where we are and where we're headed. So when you look at your coverage universe, Chris, and maybe we can start with the large caps that you cover, Pfizer, Merck, Eli Lilly. Big picture, Chris, how healthy, how resilient does that sector look to you, Chris?
Yeah, thank you for having me on, Josh. I think the pharmaceutical industry is very much considered the beachhead property within healthcare broadly. The industry is quite healthy, but naturally there are always cross currents happening. I think from an innovation standpoint, we're seeing tremendous advancements in the development of novel therapies to address some of the most daunting unmet needs that people have in healthcare, particularly in cancer and cardiovascular disease. Clearly, and I'm sure we'll touch upon this, therapeutics that address obesity and overweight have very much captured headlines and drawn attention very broadly. Maybe some of the negative headwinds include the traditional aspects of thinking about policy implications. We know that the Inflation Reduction Act has a drug price negotiation component for Medicare that is beginning to play out. And this is part of the overall backdrop that the industry is navigating its way through.
Chris, I want to get to that Medicare pricing in a moment, but first I want to ask you a little bit more about this obesity versus everything else, because as you noted, it has captured a lot of the headlines, all of the air in the room, the dollars, et cetera. Do you think as a result that there are treatment areas and therefore companies that have been sort of overlooked that you think investors should be looking at right now?
To be fair, I think that there are certain aspects of the industry where almost holy grail-like opportunities have always been out there. And finding approaches for the management of weight, overweight, and obesity has clearly been amongst those for decades. And then I think we're at this juncture where we have therapeutics that are delivering meaningful benefit and also with a profile of acceptable safety that has made them go mainstream and therefore has earned that capture of attention. But to your question, I would agree. I think that there are very significant developments that perhaps don't quite connect as tangibly with mainstream folks in terms of thinking about the benefit. That isn't to say that it isn't creating very important innovations at the scientific level, whether it's genetic-based therapies, gene therapies. We're seeing some of the first that are approved. Tremendous levels of unmet need that are being addressed, perhaps not on the same scale and scope and potential global opportunity, but yet very meaningful when you think about the long history and the trajectory of our understanding of certain diseases. And I think of the constant drumbeat of the fact that perhaps in cancer, something that touches so many people's lives directly or indirectly, we are seeing continued innovation and developments, advances of some of the traditional therapies like chemotherapy, now the next generation version that's becoming very much a promising source of active treatments and research, antibody drug conjugates. So there are other areas that are very relevant. It's just hard, as you say, because all the oxygen seems to be getting drawn out of the room by the scale of the obesity opportunity.
Chris, another theme in your space has been M&A, and listen, why not? Big Pharma has plenty of cash. Do you see that theme continuing, Chris? And if so, are there any potential acquisition targets on your radar?
Yeah, I think in any of the major industries and whether you look at the landscape, it's just part of the natural history, right? We have several leading companies, I think typically about a dozen leading global companies in the US and Europe. And of those companies at the revenue scale, in order to move the needle in the minds of investors, you need to be able to continually replenish your new products that are driving the growth, as well as the pipeline, which hold the promise for future growth, embedded risks as well. All companies recognize that the innovation that they focus on in their research laboratories is very important, but the not made here mentality is the source of risk or failing for companies who rely too much upon that. So I think we would expect to see continued M&A. Another important factor in the drug industry, patents. Patents have defined dates of expiration, and we think of them in terms of ends of exclusivity or loss of exclusivity, perhaps cliffs or erosions of revenues. Companies recognize they can see this coming down the road years in advance because these are date certain events, Josh. And so from that standpoint, companies know they need to replenish their portfolios. And that's often another important reason why business development and M&A is just a foundational part of the playbook.
Chris, as I mentioned, let's get to those Medicare drug price negotiations. As you say, it was passed as part of the IRA, but we have seen sort of aspects of these negotiations becoming more clear to some extent. So which drug makers do you think are most and least affected? Do you think it's going to be material for the industry?
So I think ultimately it will touch upon the entire industry. Certainly the first year that we're seeing play out, there were 10 drugs that were selected for which the drug prices that are ultimately determined and negotiated will go into effect in 2026. We're going to learn what those 10 negotiated price levels are by September 1st. So that's not too far away from now. From that standpoint, this will go on as part of the Inflation Reduction Act, IRA, with a set protocol in terms of thinking about how in subsequent years, starting in 2027, 2028, it will expand both in terms of the number of drugs and not to get too inside baseball, but in terms of thinking about Medicare, there's Part D, but there's also Part B. And so there'll be an expansion in the number and the breadth of potential drugs that could be included. So ultimately, it is very relevant for every company across the industry. However, need to recognize that innovation is at the core of the driving force. Companies can, again, anticipate this, and therefore we're seeing that markets for products are truly global. Medicare is an important payer, but only one of several components.
Chris, great having you on the show today. We appreciate your time. Have a great weekend.
Thank you, Josh and Julie. Good to see you both.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended on the day lower after starting the day higher pretty much across the board here. So the Dow down by about 41 points, about 0.1% here. On the week, we see really little change, very much a sideways movement. The S&P 500 down 0.4% on the day, and also seeing that drop as the day progressed. Of course, it is end of quarter, end of month, end of first half of the year. So you do see traders sort of rejiggering positions going into that as they want to sort of solidify what their reports are going to look like for the first half and for the first quarter, or for the second quarter. And the Nasdaq, the worst performer on the day, down 0.7% here. So seeing that downward movement. Also, a quick check on what's going on with yields as we got that inflation data this morning. They came in bang in line with estimates, continue to show that we are seeing inflation moderate, and yet not seeing moderation in the 10-year, 4.34%. Jared?
Yes, kind of a ho-hum way to end the quarter here. A little bit of downside action in the indices, and I'm going to do a fuller recap in about 30 minutes with Josh here, but let's take a look. We're looking at the Nasdaq 100 intraday here. A lot of red in the mega caps. Let's just quickly put what happened during the week, and you can see kind of a mixed bag here. Chip stocks didn't do so well, and we'll get to those in a second, but overall, let's check out the sector action. Only energy and communication services in the green. To the downside, utilities down the most, 1.8%, but also materials, staples, and tech all down 1% or more. When we take a look at the leaders here, regional banks did the best. KRE up 4.5% or thereabouts. Solar energy, day after the debates, they are not doing well. Could be an election play there. Also, Bitcoin this week down about 6.7%. Cannabis stocks, Chinese stocks. So a little bit of risk off here, but certainly no disasters. And again, we'll be exploring this in depth, Josh, in just a few minutes.
I look forward to it, Jared. Thank you. As the first half comes to a close, the S&P 500 is on a tear. It's up about 15% on the year already, driven largely by big tech and AI. Our next guest thinks this bull market still has room to run. For more, we're bringing in Ed Clissold, Chief U.S. Strategist at Ned Davis Research. Ed, it's good to see you. So it sounds like what you're saying, Ed, here is, listen, if the economy's decent and earnings are decent, let's not overthink it, that the good times can continue.
Yeah, that's a great summary. Let's not get too caught up in the minutia. Earnings growth is going to be pretty solid this year. We're getting quarter-on-quarter acceleration in growth. There's probably going to be some downside revisions just because second half estimates are a little bit rosy, but overall good earnings growth. And while the economy is slowing, the chances of a recession over the near term are pretty low, and that's a recipe for the Fed to likely be able to cut probably once in the second half of the year. And so a slow easing cycle, decent earnings growth, and moderate and falling inflation, that's a pretty good backdrop.
You know, Ed, you might have seen J.P. Morgan's Marco Kalanovich came out with a note today and said he thinks the S&P 500 is going to fall to 4,200 by year's end. Among other things, he thinks that the market is pricing in too optimistic an outlook for a broadening of earnings growth beyond tech mega cap. What do you think of that scenario?
Well, I think a 4,200 price target implies a recession's coming. You normally don't get that kind of a decline unless you're going into a recession. So it's not just hey, earnings growth may not be as good as we think. That's really saying that there's some really bad news coming down the pike. That's not really what we think is probably going to happen. Now, I mentioned earlier, earnings expectations second half probably a little bit too rosy. Consensus estimates about 20% for Q3 and Q4 versus the previous year. It's probably more like high single digits to low double digits. So there'll be some downward revisions. But I think if you want to talk about risks, probably the bigger risk is that after such a good first half of the year, a lot of people are in the market. So a little bit of bad news could cause a pullback, but we'd be looking for a pullback to maybe a small correction, not necessarily a bear market.
And another, we're talking about variables for investors to consider. Another one I want your take on is just valuation. When you look at where we're at right now with the market, Ed, how does valuation look to you? Does attractive, extended? How would you characterize it?
Yeah, stocks are a little bit stretched. If you were to look at the trailing PE for the S&P 500, it's above its long-term average. Not hugely so. I like to say if it's more than 2 standard deviations, that's like the top 5%. Of observations, that's when it becomes like a real front burner issue. Usually it's when earnings growth rolls over, that's when these kind of moderately elevated valuations become a bigger issue. I think where I'm more focused for the second half of the year is relative valuations, that is stocks versus bonds. We've entered a regime where if bond yields spike, then we saw that, for example, last year, 10-year got up to 5%, and we got a 10% decline in the S&P 500 pretty quickly. I think that's That's the bigger risk. Not our base case, but if, let's say, inflation does remain sticky and you get inflation expectations getting out of hand and interest rates start to rise again, that's when investors may say, hey, I'm getting better deal in the bond market, so let's focus there. So that's, I think, where the valuation risks are.
What do you think is going to propel stocks higher in the second half of the year? Is it going to continue to be tech mega caps? Is it going to be other areas that are going to start to play more catch up?
Yeah, so as of right now, we're overweight tech and we're overweight growth. So that's kind of more of the same. And more broadly, if you're getting a modest slowdown in economic growth, the stocks that tend to do well are growth stocks because they don't need the economy to do very well to grow their earnings. They're not like an industrial company or materials or energy that are really levered to the economy. So that's where we are at the moment. Now, I think if we do get into a little bit of a pullback or even closer to correction territory, then you want to get defensive. That's where utilities, staples, healthcare and telecom, those tend to do best. Again, that's not where we are at the moment, but if people are thinking along those terms, maybe now's the time to do a little bit of research to see which sectors and which stocks you want to focus on.
Ed, I can't let you get out of here talking about politics. You had that big debate last night, and I'm just curious, how are you thinking about this election, just as a market strategist? How are you thinking through it?
Yeah, so the way I think about it is election year rallies often start when it becomes clear who the winner is going to be. Like in 1996, very clear Clinton was going to get reelected. You had two very small pullbacks first half of the year, and the market ripped higher the second half. 2004, different situation. Bush, Kerry, very close. It wasn't until election night that it became clear Bush was going to win. And then after that, the market ripped higher the last couple months of the year. So we were thinking this is going to be a very close election. Probably, still is. But if momentum starts to move towards Trump's direction because of Biden's performance, maybe that election year rally starts a little bit earlier. Of course, had a good start to the year, second best first half of election year since 1928. So we've already priced in some good news, but maybe some of that general election uncertainty dissipates if it becomes clear who the winner is going to be.
We shall see. I'm not holding my breath, Ed. Thanks a lot. Appreciate it. Well, JP Morgan, thanks. JP Morgan releasing its new 2024 mid-year outlook today. Here to help break it all down is Yahoo Finance's Josh Schaefer. I've alluded to this a couple of times because it was Marko Kolanovic, one of the few bears who remains on Wall Street.
Marko holds a 4,200 call on the S&P 500, which would be an over 20% fall from where we are now. They haven't moved their target, which I think is notable. And a lot of times I think you do see this, Julie, where you have a very low target. I don't think he's that tempted to chase exactly where the market's going to fall. So like 4,200 to me is a little bit arbitrary when it comes to that. But essentially JPM saying here similar things they've been saying since the start of the year, which is you have frothy sentiment, you have valuations that are high. They don't feel great about that sort of dynamic in the market right now. And so I kind of took that note and then I broadened it out to what other strategists are saying too, and kind of created three risks that people are watching heading into the second half of the year, because we kind of went up in more or less a straight line to start the year. And one thing that a lot of folks are talking about right now is the labor market. And I think that's going to be a continued focus going into the second half of the year, and specifically if we see any kind of a downturn. And that goes with labor market downturn would equal economic weakness. Citi's economics team still has a recession call. Scott Cronert mentioned that in his note today. He's their equity strategist, but he said, well, if my team's still sitting on a recession call, maybe we do get a pullback in stocks. Their call is 5,600 in the S&P, but at some point, maybe that there's a little bit of a push-pull there when it comes to the labor market. And then as far as sentiment goes, Citi uses this thing called the Levkovich Index to look at whether we're in a period of euphoria or a period of panic when it comes to sort of stock market, different aspects of the market. You can see here, we just barely got into euphoria over the last couple months. And so you could call sentiment frothy, but kind of one of the other takeaways from this chart is you can see how long sentiment can be frothy. If you look at the 2000s period there, we were well above that light blue line for a long time. We were above there for a little bit in 2020.
It's still in the bounds, it looks like, in that chart.
It's a little bit above it if we really zoomed in, but yes, it's not out of control.
And by the way, that index named for late strategist Tobias Levkovich, who was a wonderful person to talk to about the markets, and it's great that they have that index that is named for him.
A final thing, Josh.
Yes.
we were talking about pullbacks, and I think it's just important to understand that we haven't had a real pullback yet this year. We had a 5% pullback in April, but when you look long term, the average is closer to about 14% over the last 40 years for the S&P 500. Keith Lerner over at Truist highlighted this a while back, and we've sort of just been updating that chart. And I think the takeaway here being you almost should expect more of a pullback at some point. It wouldn't be abnormal at all. The way the stock market went up actually for the first 6 months this year is probably more abnormal. And so as you think about things you guys have been talking about today with the election and potential volatility maybe coming into the market, remember the VIX is near historic lows. Our Jared Blickery talks about it most days, and it hasn't moved all that much. So if that starts to play in a little bit more, maybe that's when you finally see stocks stop going up seemingly every day.
Yeah. You know what I liked about this note, too? They talked about the election and the debate. And obviously, they published before the debate, and they told their clients, you know, that it could really clarify, talking about the debate, the key policy platforms for the candidates. I don't know policy.
It clarified something, I guess. I don't know.
Or visuals.
Yeah.
I don't know policy.
Yeah.
Maybe they'll revisit that one. Joshua, thank you. Appreciate that. Coming up, find out how to best position your portfolio ahead of any election year volatility. More market domination overtime is coming right up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
The first presidential debate is now in the rearview mirror, and investors are looking for ways to play the market ahead of the election in November. And joining us now to help us understand how to do just that is Alex Saunders, head of quantitative macro strategy at Citi Research. Alex, it's good to see you. So you were previewing this debate for your clients, Alex. You said, you thought the debate's policy discussions would be rather surface level. You nailed that one, Alex. Then you go on to say you thought the market effects, such as they may be, would be rather short-lived. How come, Alex? Why'd you make that call?
Yeah, I mean, the big point to make, and we wrote it in our preview yesterday, is that we're still very early in the election cycle. Right? We don't have debates this early. I mean, we're still in June. And one thing that didn't change last night is that we're just one day closer. The reaction of the betting markets is quite pronounced in terms of Trump's prospects, but it will take a week or so before that's reflected really in the voter polling. So the market reaction that we did see was quite mild, and it mean reverted. As you had said, we expected that debate to be policy light, and it was policy light, but there was some incremental information that we took from the debate yesterday. Trump leaned into the tax cuts, and there was nothing really of substance on entitlements or the deficit questions. He pivoted away. Neither candidate really addressed those concerns. So we think that later in the cycle, those fiscal concerns could come to the fore.
Alex, in the wake of the debate, I'm curious what you're hearing from clients, what questions they have, what concerns they have. What are they coming to you with today?
Yeah, so it is really focused on the rates market, I would say. And the point that we would make on that is, in terms of the market impact, the makeup of government is crucial. So split Congress is much more bond market friendly because there's just less capacity to implement some of these large potential policy changes. So in that sense, if and how Biden's performance yesterday affects down ballot Dems is also important. They were polling ahead anyway. But for the moment, it really is a rate story. We would say that currently there's an uneasy tension between these fiscal concerns and the deficit, and then the cyclical factors such as slowing growth, the labor market that you had mentioned earlier, and a dovish Fed. And we don't expect that to be resolved in the near term. So both the market and the Fed are highly data dependent. As we move closer to election day, and if the polling leans towards a red sweep or even a blue wave, those concerns become more important. But between now and then, there's plenty of macro relevant data.
And Alex, you do point out broadly, election years typically strong for equities. Just break that down for us. What do the historical patterns teach us?
Yeah, so typically you have strong equity performance in an election year, and that performance is even stronger when you have an incumbent running, as we have now. But the other thing that we highlight for clients, and again, it goes to that we're still quite early in this election cycle, is that around about 2 to 3 months, according to our studies, not just in the US, but also global elections, you do tend to get a bit of a risk premium built in. So it's a small pullback, as you might say, in equity markets. So that's something to be aware of. But again, that is a Labor Day, post-Labor Day story, September time, rather than something that you should be worried about now during the summer, where we have Fed meetings, we have another earnings season, and Citi even thinks that the Fed will potentially cut rates before there is an election.
Well, and Alex, to your point, you're sort of talking about this dual drivers for the market in the election and the Fed. The Fed has consistently been the more important driver, right? And this is something that we have heard from strategists over and over again. So do you think then, as we get to 2 months out from the election, say, that will flip and that the election will become more important than the Fed? Or do you think the Fed is still going to hold primacy there?
No, I think there will be an inflection point. There will be an inflection point from the Fed. Again, this will probably be post the September meeting towards election concerns. And to a certain extent, it will depend on the polling. If we do have something where it looks like there's split ticket voting and we could have a split Congress, which is quite likely given the electoral map in the Senate, and in the case of a Democratic win, less likely, but the House is more challenging for Republicans. If we do get a split Congress, I think the bond market will be breathing a sigh of relief. But if polling leans either way, then those fiscal concerns will become much more of a driver than the nearer term policy of the FOMC and the Fed.
And Alex, just to put a fine point on it here, what would be the ideal scenario for equities in your estimation in terms of both the presidency and Congress? I assume it would be split Congress, but then do the markets have a preference for either candidate at this point?
Yeah, that's a very, very good question. I think what we saw during the debate in terms of the market impact was really like a mini window or a microcosm of how the market views it. And in terms of, I think that Trump had the better of the debate. We saw equities rally, we saw the dollar rally, and we saw bonds sell off. And so I think in the short term, that would probably be the best scenario for equities. But again, it's conditional on these fiscal concerns not really arising. So a split Congress potentially with a Republican president is something where the market, the equity market, would probably rally on.
Well, we'll check back in as we get closer to it all. Thanks a lot, Alex. Appreciate it.
Thank you.
A bumpy road for EVs. Automotive research firm J.D. Power revealing several issues troubling battery electric vehicles. Yahoo Finance's Prasad Subramanian joins us here with the details. So already we have slowing sales. So what are these issues that we're talking about?
Yeah, so in the past, people have thought EVs are sort of they don't need much maintenance. They're simpler to use. They just have a battery, a motor, some wiring. You don't have 1,000 parts spinning in a motor. But apparently, with J.D. Power's latest initial quality survey, amongst the brand rankings that they break it down by car, and they notice that they do a metric called problems per 100 vehicles. And for EVs, that number is 266 problems per 100 vehicles, whereas for gas-powered cars, it's only 180. So 86 less problems per vehicle or per 100 vehicles. Kind of a big discrepancy there. It's kind of surprising. And J.D. Power said that this is because these EVs, of course, they're newer, they're more complicated, more technology. People bringing them into the repair shops because they have issues with certain things. And then the complexity of that is also an issue. You need only so few kinds of technicians that can deal with that. So the EVs are kind of giving them more problems. But in particular, Tesla, their initial quality score has sort of gone down in a bad way, and they surmise because changes to the new Model Y and Model 3, no turn signal stalks, no wiper control. It's all in the screen, or it's on the steering wheel. So that's kind of causing some problems for people. They're complaining about that, and they surmise that's why Tesla's score has gone down in the most recent rankings.
Beyond Tesla, any other brands get knocked around a bit?
Yeah, so we have, we look at the top brand, believe it or not, was Ram. They have been a brand that's sort of been knocked around because of their trucks had some issues, but this year, doing really well here. Some of the worst brands were Tesla, Rivian, Polestar. Unfortunately for them, Dodge also pretty bad there as well. Amongst the luxury brands, it's Porsche, Lexus, and Genesis were the top 3 luxury or premium brands in the rankings.
All right.
Interesting stuff.
Praz, thank you. Appreciate it. Time now for what to watch next week, starting off with jobs. The June jobs report is coming out on Friday. Economists forecasting non-farm payrolls and hourly wages to decline while they're expecting unemployment to hold steady.
And ahead of Friday's jobs report, we'll be getting a new JOLTS report for May on Tuesday. That number expected to tick down slightly compared to April. All the job data next week giving us more insight into the health of the labor force as the Fed continues to weigh timing of rate cuts.
And speaking of the Fed Chair Jerome Powell is set to speak at the European Central Bank Forum in Portugal on Tuesday. Following that, minutes from the June's FOMC meeting are due out on Wednesday.
And finally, Constellation Brands will be reporting earnings on Wednesday. The beer, wine, and spirits producer announcing first quarter results. Analysts expecting the report to highlight the durability of the beer business driven by volume growth and higher prices. And that'll do it for today's Market Domination Overtime. Be sure to come back Monday, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell.
Don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Are you intrigued by the final frontier? You're not alone. The space race isn't just about landing on the moon or even tourism for the wealthiest people in the world. It has the potential to gather and distribute vast amount of data, and it could even be a manufacturing hub for your favorite products. We'll chat with advocates and enthusiasts about why space is a real investment destination. From Starlink's biggest competitors to the perils of space junk, we'll bring you top insights. Join us for Yahoo Finance's Space Race, Investing in the Final Frontier.
Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving right into, and just like that, we're halfway through 2024, and the market is all about AI. Year to date, the tech-heavy Nasdaq has led gains among the broader indices, and now, of course, investors are looking for a broadening rally in the latter half of the year, though the November election could complicate the market's momentum. Plus, after a muted performance from Biden in last night's debate, some are wondering if the president can make it another 4 years. The decision to drop out of the race is entirely up to Biden, says PIMCO's Libby Cantrell, or is it? and we're less than a month away from the Olympic Games. AI could make cyber attacks more complicated than ever before. We're going to be breaking down the biggest threats with an expert. That's coming up next. Right now, stocks close lower in the final trading day of the week amid and quarter. Meanwhile, the AI frenzy leads stocks to a rip-roaring first half of the year. Yahoo Finance's Jared Blick rejoins us now with more on the trading day takeaways. Jared.
Josh, this might come as a surprise, but mega cap still dominating the returns this year. And I'm going to switch over to some of our heat maps and just show you the year-to-date results in sectors. Up number one is communication services, and then you have tech. And communication services, by the way, let's go over to the Nasdaq 100 because that has all of the big components here. That has Alphabet and also Meta. So you can see Meta up 42%, Alphabet up 30%, yeah. And tech is number two, helped, NVIDIA up 150%. That helps as well, Microsoft. But these are year to date. Even if you look at the last month, you still see a lot of green there. You take a look at the sectors, and you can see tech, it's not communication services, that's XLC, discretionary, and then real estate. So discretionary has Tesla and Amazon. Amazon recently reached some new highs there.
So big names, Jared, well-known names, the big sectors. Under the hood, I mean, other, some verticals, some subsectors, some indices. What do you got?
Let's go to our leaders here. This is over the last month. Let me put the year-to-date totals. Guess what is in the number one spot? That is crypto. GBTC up 53%. Depending on your exact metric, you're going to see some pretty big returns in there. Then we have New York FANG. That's the mega caps, then SOX. But you were asking about some of those smaller plays. I like biotech. We were looking at that yesterday. Don't like solar right now. You can see solar, especially not in favor after the debate last night, but also unprofitable tech. You can see ARC down there, down 16%. So what has been really interesting is a dichotomy between the semiconductors and the software. So here's semiconductors. Let me just show you over the last month. See a lot. Well, you see some red there too. And then you take a look at software. Software really came roaring back. So these two are kind of jockeying for position there.
All right. Next bullet point, the Jared takeaway number two.
All right, we are looking at the S&P 500 is kind of doing the opposite of what its individual components are doing. Swimming against the tide is what I'm calling it. And this is a bespoke chart. This goes back to 1990, and each of these bars represents the percentage days of the year in the S&P 500 when it's swimming against the tide of its own components. That is, if you have more than half of its components, 250 that are going up, S&P 500 going down, well, that counts as one. And in fact, it happened only today. The S&P 500 closed up, but we had more down issues than up issues. All of this is relevant, Josh, because it kind of paints a picture where we might be echoing an epic from the past.
I'm going to ask you, looks like, according to this chart, Jared, the last time we did this right around 1995. So any parallels, any conclusions I should draw from that?
The 1990s, really interesting time period. Some people compare the current epic to the 1999 dot-com bubble, but I've seen a lot of evidence that where we are right now is actually in the mid-90s. So we haven't even experienced those blow-off top euphoria levels. I showed this chart yesterday. I'm not going to spend a lot of time on it, but this is basically S&P 500 correlations. We are at some low levels, and guess what happened in the mid-90s? We were at those low levels for a very long time. So the bottom line is, the current concentration status quo could last longer than people expect.
All right, third and final.
All right, what is in store for Q3 and Q4?
Are we going to go seasonality? We're going music to my ears.
People demand it. Yes, Josh. I have another one. This is a brand new one. We've been doing these for a couple weeks now. We were focusing on July.
Look at that. That's interesting, yeah.
I am showing you is the entire year. So I looked at all the years going back to 1928 when the S&P 500 is up 10% or more by the end of June, like it is this year, up 15%. And you can see that the rest of the year trails off. In July, you still average, you see
and
average
then
returns.
Head into fall.
But then the things get a little bit dark. They get a little bit dreary in there.
And then look at November.
Yes, November. Guess what happens in November? That's an election. Now, this isn't geared towards election years or the presidential cycle, but I think it is notable because I was showing this chart only yesterday. This is VIX seasonality. Guess what happens in mid-August through October? That is primetime crash season. So that's when you see the VIX shoot up a lot of years. And so that contributes to what we're seeing right here in this chart. So All in all, I'm expecting a positive beginning to July, but then as we get farther into the fall there, who knows?
Jared Blickery, thank you, my friend.
You bet.
Great takeaways. All right, moving on. 2024 Summer Olympic Games in Paris, quickly approaching. According to various estimates, more than 15 million visitors are expected during the event. With all this attention also comes, of course, the unwanted eye of cyber criminals. The Olympics have long been a target to cyber attacks. The Tokyo Games seeing a staggering 450 million cyber threats, 2.5 times the number of attacks seen during the London Olympic Games. So what is in store for this year in Paris? Arctic Wolf CEO and President Nick Schneider joins us now to discuss. Nick, thanks for joining us. Actually, Nick, before we get into that, I actually was interested, since we have you have such a unique insight here, kind of broadly, higher level, Nick. You know, we see signs that, of course, the economy could be cooling. Against that backdrop, Nick, I'm just curious, in your industry, what is spending like on security right now? What is demand, Nick? Is it strong?
Yeah, first of all, thanks for having me. I think cybersecurity is an industry that, unfortunately is constantly in high demand. I think the threat actors are becoming more sophisticated. I think there are new opportunities, particular AI for those threat actors to leverage new techniques with organizations. So the demand environment is quite high, and I think you're seeing that through the resiliency of the cybersecurity market, in the public markets itself.
All right, Nick, let's skip ahead now to an event that I'm sure is on your industry's radar. That is the Olympics, as we were mentioning. The games often the receiving end, the target of cyber attacks. I'm curious, Nick, do you expect that same pattern to hold this year?
Yeah, I think it will. You have an event where there's broad global scale. Millions of people are attending, thousands of vendors are being used, throughout the event over a, relatively short period of time, which just presents an enormous opportunity for supply chain attacks. And especially, as much as those organizations would, attempt to prepare, they're asked to do a lot in a relatively short amount of time. And a lot of these organizations are standing up operations in a location or in a type of event that they're not used to. Which just prevents an opportunity for the bad actors. And I think on top of that, with the global stage, some of the geopolitical tensions will come across, more notably, which is an opportunity again for bad actors. And then, I suspect we're going to see some increased use of AI kind of throughout the games, both in the way in which they're kind of presented, but also the way in which they're produced. And that itself will also present a new opportunity, I think, for bad actors throughout this Olympic Games.
When you mention bad actors, Nick, who are we talking about there? I mean, are we talking about, is it criminal gangs? Is it rogue states? All the above?
All of the above. And I think especially in an event of this scale, of this magnitude, and especially since it involves such a, broad set of organizations or broad set of, countries, you're going to see a mix of kind of all of the above throughout the event itself.
And when we talk about the attacks themselves, Nick, what do they look like? What form do they take?
Yeah, they'll take all of the standard, forms of attack, right? So I think folks will be attacking, again, the supply chains. I think the bad actors will be looking for vulnerabilities. I do think we'll probably see some nation state activity, and that will get, into these environments through some of the less sophisticated means, but also through, more sophisticated means. And like I mentioned earlier, I think AI presents a new opportunity for the bad actors and a new vector even of attack as an attack surface in itself. And that all provides, on the context of this large global stage, a massive opportunity for the bad actors. And it just means that those that are participating in the games or a part of the, the games production need to really remain vigilant and do what is necessary to become, protected as an organization.
You mentioned AI there, Nick. So you would expect perhaps bad actors use AI. On the other hand, though, would you expect cyber security officials to also integrate, deploy AI defensively?
Yeah, I think we'll see AI being used in both directions. So the good news is it can be used, defensively. The bad news is it can be used offensively. And, I think there's a healthy balance there. I think right now, just the sheer breadth of the ability to use AI in a negative, fashion probably slightly outweighs the benefits of the proactive, response with regards to AI. But that doesn't discount, all of the blocking and tackling that organizations can do that is more standard, cybersecurity hygiene that could really help them, prevent anything significant.
Nick, terrific discussion and a really interesting topic. Thanks so much for taking the time to chat today. Appreciate it.
Thank you.
And coming up, President Biden assuring voters today that he's up for the job after a weak debate performance raised questions around his age. More on whether we're going to see him on the ballot in November. That is coming up next. America's biggest banks unveiling capital plans after the results of the stress test earlier this week. Julie Hyman is back here with us with the very latest details. Julie.
So basically what we have now are all of the big banks letting us know what their dividends will be and what their stock buyback plans will be. So let me give you the headlines first and then explain what's going on here and why we're learning about this right now. Citigroup, let's start there, is planning a quarterly dividend of 56 cents a share here. That is an increase in the company's dividend here by a few cents here. We've got JP Morgan says it's going to boost its quarterly dividend to $1.25 from $1.15. And JP Morgan is also planning a new buyback plan of up to $30 billion. That's its new authorization that replaces its previous authorization. Wells Fargo said it's going to boost its third quarter stock dividend to 40 cents a share. It's a gain of about 14% for that company. And then you also have B of A, Bank of America, which is also raising its dividend as part of this to 26 cents a share from 24 cents a share. Why are we getting all of these right now? Well, as you know, because our Jennifer Schomburger covered it, every year the banks have to go through this stress testing from the Federal Reserve. This was something enacted during the financial crisis, as you know, that made sure that the banks had adequate capital in the event of an emergency.
So they sort of the Fed models it out.
Yes, they say if everything goes to hell, like it did during the financial crisis, how would these banks look? Would they have enough capital to cover their losses? Once they pass those stress tests, then the banks can come up with a capital return plan, i.e. buybacks and dividends. They submit that for approval, they get approved, then they all announce it on the same day. So that is where we're at.
Which is why, if you're an investor in a big bank, you were watching those stress tests.
Yeah, you were waiting. What were you going to get back in terms of the cash? So I just mentioned a few of them, but any bank you can think of today is coming out with this information. And so if you're an investor in any of these banks, you should check out, for example, Morgan Stanley, its dividend going to 92.5 cents, buyback of up to $20 billion, Fifth Third out with its news on this too. So all of the banks coming out with their
All right, some nice weekend
buyback
news.
plans.
There you go. Julie, thank you. Appreciate it. The Biden campaign trying to do damage control after the president's disastrous performance on that debate stage last night. But today, President Biden defied calls to leave the race at a rally in North Carolina.
I know I'm not a young man. State the obvious. Well, I know. I don't walk as easy as I used to. I don't speak as smoothly as I used to. I don't debate as well as I used to. But I know what I do know. I know how to tell the truth. I know how to do this job. I know how to get things done. And I know, like millions of Americans know, when you get knocked down, you get back up. I give you my word as a Biden, I would not be running again if I didn't believe with all my heart and soul I can do this job.
Alex Thompson, Axios national political correspondent, joins us now. Alex, it is good to see you. So the headline of your report, Alex, was this: Biden's debate is a DEFCON 1 moment for Democrats. You spoke with insiders in the Democratic Party, Alex, today. What are they telling you?
So there's a few things, and apologies for my casual appearance. I literally just walked in the
It's okay,
door
Alex. It's a casual
from the
show.
Atlanta plane.
No criticism.
But anyways, so there are a few things going on. One is there's already some internal finger pointing over what just happened about, and some of it's directed towards Biden, but also some of it's directed toward the debate prep team, and feeling that they probably over-prepared him, sort of like stuffed his head with a bunch of stats and minutia, and what would have been better if he had just sort of rested. Now, that's some of the internal politicking, but the thing is, this is a huge potential crisis for the Biden campaign, because going into this debate, the Biden campaign was already behind Trump. If the election had been held before the debate, almost certainly Trump would have won, or was certainly favored to win. And so this debate was sort of seen as a way of reminding voters Donald Trump could be president again. But instead of it actually rebounding to the Biden team's benefit, it actually backfired on them, given that he meandered, was speaking in a hoarse voice, was really just having a hard time even connecting sentences in that debate. But as you saw in that rally, despite some Democrats, always anonymously, which is important, because if Democrats want to put their name on something, that could maybe change something. But the fact that Democrats are griping anonymously, the Biden campaign doesn't care, and they are making clear that they're in it. You also saw Barack Obama post on social media today his support for Biden, which was a huge sign to the rest of the Democratic establishment. So there's a lot of nervous Democrats. I'd say Biden is on sort of probation, but you're seeing Biden try to really reconstruct and recover from that bad debate performance.
Alex, you noted in your piece how the feeling was there's just one person who could end Biden's campaign, and that is Biden himself. I wonder, though, Alex, what you make of sort of Joe Biden's role here, and her possible impact and influence, because she is very active, Alex, and of course, very involved. You see her there. How are you thinking about that relation and her possible impact on whether it continues, the campaign continues?
You're seeing her role become more and more prominent. I mean, Joe Biden wouldn't have run in 2020 without Jill Biden's support. He wouldn't have run this time without Jill Biden being very enthusiastic about it. And I don't think it's a surprise that at the rally after the debate last night, Jill Biden went on stage and praised him and sort of did this, little bit rally of, Trump lies. And then she also introduced him in that North Carolina rally and, was just as sort of rousing as him. You can see, despite the fact that in her past, she's been a little bit more, she's always been, in her past, she was uncomfortable being a political spouse. But in this version of Jill Biden, she's more, I guess, like 1990s Hillary Clinton than 1990s Jill Biden. I mean, she's very, very involved, and as long as she still wants to run, I imagine Joe Biden wants to run too.
Alex, let's push it forward here. We're waiting to hear whether big donors, the big names who write the big checks, do they publicly voice their concerns? Do congressional Democrats, make their worries public? What do you expect?
It's going to be really fascinating this weekend because Joe Biden does have a few fundraisers, including in the Hamptons tomorrow night. And, just within sort of like donor cliche world, the Hamptons are sort of notoriously known as being difficult donors, quote unquote, and that they ask very hard questions. They're usually very, very skeptical, and they all watch that debate, I guarantee you. And I'm really curious to see, if they see him tomorrow night and aren't impressed, that's the sort of crowd that will talk, and they'll talk to reporters. And then if they talk to reporters, you could see, rush out. But at the moment, it's basically just, we're not sure. We don't feel very comfortable, but we're just sort of waiting and seeing for now.
All right, Alex, if those folks talk to you, let us know. We'll have to have you right back on the show. Thanks for joining us, Alex. Appreciate it.
Thanks.
And before we go to break, here's a preview of our new podcast, Financial Freestyle.
Sitting here right now, 2024, still 40% of all Americans run out of money in retirement, right? 53% of African-American households run out of money in retirement. So we are looking at a system. If that system is broken, everything breaks down. So if your parents, can't run out of money in retirement, then you have to start funding them because they don't have money. So that's taking money out of what should be your nest egg, which you should be passing on to your kids. So it's just a generational deficit if we can't retire the right way.
Financial Freestyle with Ross Mack debuts on Monday, July 1st at 12 p.m. Eastern. We're asking for a trend on the other side. Tractor Supply become one of the first companies to publicly say it's eliminating diversity, equity, and inclusion roles and goals, and it's part of a broader trend. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Indeed, Josh. So let's talk first of all about what Tractor Supply is doing. And it is saying it's doing this in response to feedback, basically, from customers. They say we've heard from customers that we have disappointed them. So what is the company doing? It's no longer going to be submitting data to the Human Rights Campaign and to LGBT groups. And speaking of LGBT, the company is not going to be sponsoring what it calls non-business activities like pride festivals and voting campaigns any longer. The company is also withdrawing its carbon emission goals and focusing on land and water conservation efforts. And finally, the company is getting rid of DEI roles and also retiring their current DEI goals while somehow still ensuring a respectful environment, in their words. So again, this is in response to what they've heard. But to your point, this is not happening in isolation. We have had a backlash against companies who have had explicit DEI goals and DEI roles at their companies, something that had seen an uptick during the pandemic and in the wake of and surrounding the events around Black Lives Matter and that movement. So one way of measuring this is how many DEI roles are there? This data coming to us from Revelio Labs, and the chief economist there, Lisa Simon, sharing this updated data with me, basically, that DEI roles are down now almost 10%. They peaked in 2023 here, as we talked about what was sort of going on around, well, this isn't working. But anyway, you see the big run up that we had seen in these DEI roles as measured by Revelio, and then here that decline that we have seen as there has been that backlash here. There are a lot of companies who have sort of more quietly backed away from these goals and these roles. Tractor Supply, as you mentioned, Josh, one of the companies that has come out with a more public-facing statement on these matters, but we'll continue to track this and see if we see a continuation of the decrease in these types of roles.
All right, Julie, thank you so much. And that is a wrap on today's Asking for a Trend. Have a great weekend.